a comprehensive look at trends, fund profiles, and more in Exploring ETFs.
Gold has been getting some attention lately, and also in the ETF space as well as in the physical metal space. Our ETF research director, Nina Mishra, is here to tell us all about that. So the metal started off 2017 on a pretty positive note.
Yes.
ETFs are following.
Right. So gold is actually shining this year.
Yeah.
The metal is up more than 5% already this year. And this is because gold and other safe haven assets, they perform well in an uncertain environment.
Sure.
And so that is why gold has sold off after election, because this the election related uncertainty ended, and investors started dumping safe haven assets. On the other hand, the US dollar had gained after election. It had surged on hopes of faster economic growth and higher interest rates in the US. And gold and the US dollar, they usually move in opposite directions. But of late, there are increasing concerns about incoming administration's policies, particularly after Trump's first press conference, which revealed very little details about his policies. So many investors are now worried that market may have been priced in the best case scenario of growth and inflation picking up. And if the incoming administration is not able to deliver on Trump's promises, then there is a lot of scope for disappointment. So that is why gold has gained this year. And Brexit-related uncertainty has also boosted the metal. And there are reports of increasing demand from China ahead of the Lunar New Year. So those are the reasons why gold has been shining this year.
So what do you think about the future? What about going forward? Can these gains continue?
I think gold could continue to slowly climb higher this year because there's a lot of uncertainty, including policy uncertainty in the US and then political uncertainty in the Eurozone, because 3 major countries in the Eurozone will hold elections this year. And of late, populist candidates have been gaining in polls. So that leads to questions about the future of Eurozone itself. Then there is rising risk of a global trade war this year. But at the same time, gains are going to be capped if the Fed starts raising rates again. Higher rates are going to cap gold's gain. So I think it will continue its slow climb, but gains are not going to be spectacular this year.
Not going to shoot ahead anytime
exactly.
soon.
But I usually recommend a small position in gold, about 5% of the total portfolio, just because of its diversification benefits, because gold is not correlated with, usually inversely correlated with most other assets, including stocks.
All right, you want to take a look at 2 ETFs that actually hold the physical metal.
Yes, so for investors who are interested in investing in gold ETFs, these physically backed gold ETFs provide the easiest way, most convenient and low-cost way of investing and gaining exposure to the metal itself. The first one, the most popular one, is GLD, and this charges an expense ratio of 40 basis points, up about 5.7% this year. The second one is by iShares. The ticker is IAU. It is in fact cheaper, 25 basis points in expenses, and performance has been the same.
And if you don't want the ETFs that hold the physical metal, there's always the gold miners, right?
Yes. So gold miners are like leverage play on the metal. So those are more suitable for investors who want higher return, but they want to take higher risk as well. They are more volatile than the physical gold and physical gold ETFs. And investors should also remember that these mining ETFs, they hold a lot of international companies, so they also get exposure to currency volatility if they decide to invest in these ETFs.
Sure, that's a good point
Yeah.
that you brought up. Do you own either of the two that you spoke about?
There are two coal mining ETFs, which
Oh,
I
okay.
have on the table here. The first one is GDX, which is most popular one. It charges 52 basis points in expenses, and as I mentioned that it's a leverage play, so it is up about 11.7% this year, and the exposure to US is just about 18%. The rest is all international exposure. And if you want to take further risk in hopes of higher return, then you can invest in junior miners gold ETF, GDXJ, which invests in smaller companies, higher risk and higher return potential than the first one itself. This charges expenses of 56 basis points, and it is up more than 20% this year. And this has US exposure of just about 11%. Rest is all international exposure.
So now I have to ask, do you own any of the four that you mentioned?
I do own IAU.
Okay. And don't forget, you can find more information on ETFs of various sorts on our website, Zacks.com. All you need to do is get over to our homepage and then use the Funds tab in the top toolbar. That will help direct you to the ETF section of the website. With Nina, I'm Terry Ruffalo.